Hello, everybody, and welcome to another financial analysis. And today we're going to be looking at Oatly. So this is a drink which is very popular in my house. I have kids who are lactose intolerant, and Oatly has been taking off, not only in this house, but also elsewhere, as we can see. Now, their aim, they say, is as a company to make it easy for people to turn what they eat and drink into personal moments of healthy joy without recklessly taxing the planet's resources in the process. Oatly was founded back in the 1990s and is based on Swedish research from Lund University. So what we're going to do today, once again, is look at the financial statements. The company has recently floated through an IPO, an initial public offering, and we're going to look at the financials and see if you are an investor or if you're thinking about becoming an investor, what are the financial performance like of the company that you are buying. So first of all, we're going to look at their financial statements. Now, to find their financial statements, it's quite difficult to find their financial statements. This is the SEC. So if you look on their website, it says you need to send off for a prospectus on the company. If you look on the SEC, you won't see their financial statements, but what you will see is this registration statement. And the registration statement, right down at the very bottom, around about page 182, you will find the financial statements. So here are the financial statements. We've got the auditor's report signed off by Ernst & Young, a great set of auditors, a great audit company, a partnership which gives us confidence that the numbers have been well checked. And what do we see first of all? Well, if we look at the performance of this business, the first thing we notice is that the company, the sales of the company have doubled. So here we're looking at this top line here, this revenue line. The sales have gone up by, well, to be exact, it's 106%. So it's a little bit more than doubling, which is fantastic. Gross profit here is also growing as we'd expect, and they're operating at about a 31% gross margin. So 33% last year, 31% this year. So reasonably consistent, which is what we would expect. Don't forget that the cost of sales is the cost of the thing that we're selling. So it's the cost of, the packaging, for example, which they'll buy actually in, the cost of actually making the contents of this. The next line down here, this is the big one here, which is the cost of running the business. Now you can see the cost of running the business are very large indeed. So while if they sell this for $1, for example, then it costs them about 70 cents to make this. That means they make a profit of 30 cents. The problem is it's costing them another 40 cents to actually run the business. And this means that they are operating at the moment at a loss. And you will see that they've been operating last year at a loss, operating this year at a loss. So that loss is continuing. And if we just scroll down a little bit further, we'll be able to see that the bottom line is an overall loss of $60 million. Okay, $60 million up from a $35 million in the previous previous year. The other thing to notice is this line here, this financial expenses. You can see that this number has increased significantly on last year. That's the cost of the debt, and that suggests to me that they've taken on some additional debt during the year, and that is costing them in terms of that interest. Now, traditionally, we would also compare this number with the operating profit to make sure they can afford that interest, but they are operating at a loss. Okay, so having looked at the income statement, let's clear our annotations and go and look at the balance sheet. So here is the balance sheet, and up at the top we see our non-current assets. So this is the top part of the balance sheet, the non-current assets. These are the things that we need to run the business. This is this number up here, and the biggest number is the property, plant, and equipment. There's a little bit of also intangible assets, which will be things like intellectual property rights, maybe some software, maybe some patents, maybe there's some R&D in there too. Maybe they've got a kind of secret formula as to what it is that makes this stuff taste so good. So there is our non-current assets. And then if we scroll down a little bit further, we'll be able to see our current assets. Now the current assets here, these are the current assets compared with last year. So it was about $95 million last year, up to 240 million. Growing company. This is what we'd expect. We see our inventories are growing. We see the accounts receivable are growing. The interesting number here is this number here. They've got a lot of cash. So their cash has gone up significantly from 100 million from 10 million to 105 million. So very significant increase in cash, but they're loss making. They did take out a loan, but we kind of need to understand what's going on here. And I'm guessing that they've probably issued some shares as well in order to kind of booster their reserves. So lots of cash parked on the balance sheet at the moment, which is good. Scroll down a little bit further, we can see the liabilities down the bottom. So we'll just pick up the current liabilities. The current liabilities are down here. There they are. Now we can't show the current liabilities and the current assets on the same sheet, unfortunately, but the current assets, if you remember, about $240 million. Current liabilities, $228 million. Together, they're known as the working capital. So they've got 240 either as cash or coming in as cash soon, 228 going out soon. That makes me feel reasonably comfortable from a working capital, from a liquidity perspective. What is interesting here, though, is this particular number here. So a big number of that is these shareholder loans. And you'll notice that there were no shareholder loans last year. So that looks to me like the shareholders, rather than putting in additional equity, have actually lent $106 million to this company during the year in order to allow it to kind of survive, because it's got some cash flow issues, or so it would appear. Go up to the long-term liabilities. This we see the long-term liabilities. The long-term liabilities are sitting in here. So here they are. So there's our 92 million of long-term liabilities, up from 40 million. So they've actually increased their debt as well. And this is to kind of to credit institutions, by which we mean banks, as opposed to the shareholders. So overall balance sheet isn't looking too bad. You know, we've got this kind of 105 million. Don't forget, these numbers are pre-IPO, so there's nothing in there about the, you know, the sale of shares to the general public or to investment managers to raise additional cash. And what we do see on the balance sheet, if we go back to the equity side, standing out very, very clearly is here. We see that the shareholders have put in about $450 million, and they're sitting on losses so far of $120 million, up from 60 million the previous year. Okay, so this is a company, it's been raising additional share capital, it's also been raising debt to survive, and it has been making losses in the past. And the question is, how long is it going to carry on making losses before it turns the corner, starts to generate a profit, and then we start to reap the rewards? So let's go and have a look at the cash flow statement. No dividends being paid out in the movement of equity. So here is the cash flow statement, and up at the top we see the actual loss. So this is the accounting loss, and all this first part is doing is turning that accounting loss into a cash profit or loss. And what we see is that they're actually making a cash loss. So not only are these guys making an accounting loss, they're actually making a cash loss. They are burning cash, and that is not healthy for this business. Okay, so we would hope that they would be actually operating at a cash profit by this time. So they're making a cash loss. They are continuing to invest. So they are investing in property, plant and equipment, for example. And if we go and scroll a little bit further down, we can see the financing activities. Now, this is quite interesting, the financing activities. So we have the proceeds from, so they have been issuing shares. Both years they've been issuing shares, so they've been making a loss. They've been funded on a year-by-year basis by issuing more shares, diluting the existing shareholders. We can see that this is the kind of the repayment of the debt to the credit institutions, to the banks. So there's some refinancing going on here. And then we also see this number here, which is the loan from the shareholders. So it looks to me like this company, it's loss making, it's burning cash. It's realizing that it can't carry on raising money from the shareholders. It needs to go through a flotation. Now is as good a time as any. This is being shot in May 2021. The markets are very, very high. They're very, up for a flotation. And these guys have thought, look, what we'll do is we'll lend whatever that is, $87 million to the company to tie it over to the flotation. And then we will bring this company to market. So that's kind of where we're looking at. The only other thing to notice is the working capital requirement. So quite interesting looking at, if we look at the working capital in the balance sheet. So by the working capital, we're talking about this inventories here. We're talking about the trade receivables and the trade payables. It's about 45 days on the, no, hang on a sec, sorry, it's about 42 days on the inventory, taking them about 42 days to turn that over. That sounds about reasonable to me. This stuff is reasonably long lasting. I can't see a sell by date on it, but it's got a, it's not overly quick. It's not like kind of normal cow's milk. Takes them 50 days to collect their money in, which sounds quite a long time, and 45 days to pay their suppliers, which sounds reasonable. So their working capital requirement is 47 days. The problem is, based on the size of the business, the cost of sales, and the operating cost, that means that it's going to cost them about £1.3 million a day. That's about £60 million to fund the business for 47 days. And they don't really have that. So it looks to me like these guys are, they're a working capital company, but they don't really have enough working capital. And it looks to me, that's going to be one of the reasons for the IPO: raise lots of money, generate that cash, and then that will sort them out. So they'll get lots and lots of cash in. So worth going back to looking at the original IPO. So we don't have any share price information, but their IPO aims to raise 1.43 billion. There's a $17 price tag on the shares, and this is hopefully giving them a valuation of 10 billion. So 10 billion. Now it's interesting. It says it's set its sights on raising between 1.25, 1.43, and according to the proceeds will go to the company and to the selling shareholders. Now, I think that's a really important one there. So the selling shareholders, and I have no problem with some of the shareholders kind of realizing some of their investment, but there's a lot of shareholders in there. They've been funding this business for a lot of time. They've been piling the money in. They've now got the loan has gone in. The loan will almost guaranteed be repaid with this. So effectively, if you're investing in this business, you're giving the money back to the existing shareholders and taking ownership of this company. But this company, it's loss making, it's burning cash. We're giving it a big cash pile that it can carry on burning through while it turns to profitability. But it's still it's got to get past that. It's got to hit that critical mass, and the question is, what is that critical mass? It's remember the sales at $421 million right now. Does it have to go to $1 billion sales, for example, in order to hit that critical mass? What are those projections? Now, I don't know, because I don't see the analysts' forecasts. But quite interesting looking at this. It's a great product. Don't get me wrong. But based on these numbers, I'm not 100% convinced that this is worth 10 billion. The barriers to entry to the market. How easy is it to get into that market? It's pretty easy. It's really what they're trying to do is to build the brand and stick their elbows out and defend their market share through the brand rather than anything else. And actually, almond milk, etc., etc. It's reasonably easy to get into that market. So there you go. I hope you found that useful. Please do like, subscribe to this channel, and also do give me any comments. So if you like, if you've got some not inside information, but if you've got a view of the company, if you think that they signed a particular deal, or there's a big expansion, or they're just going into China, or something which I don't know about because I've just looked at the numbers, I haven't done a huge amount of research on the actual company itself. So if you want to add anything to this about why we should be investing or shouldn't be investing, then please do add it to the comments. So thank you very much for watching, and I hopefully see you on the next video.